In the dawn of the 20th century, the world economy was a fragile machine, powerful, but dangerously unstable. Empires thrived on gold, trade routes stretched across continents, and global finance seemed unstoppable. But beneath the surface lay deep fractures. Volatile markets, runaway speculation, and rigid economic doctrines shaped a world heading toward an inevitable collapse. This was the global order before Keynes, a system bound by tradition yet blind to its own weakness. For decades, the gold standard was hailed as the ultimate guardian of stability. Nations fixed their currencies to gold, believing this ancient metal could hold the world together. But, in reality, the gold standard was a cage, unyielding, unforgiving, and dangerously inflexible. When economies faltered, governments could not respond. When crises struck, the system shattered instead of adapting. The gold standard looked like order, but it was order built on sand. As the 20th century began, economists still clung to 19th century ideas. They believed markets naturally corrected themselves, governments should stay out of economic affairs, and recessions were simply nature's way of cleansing excess. This rigid ideology allowed no room for human realities: unemployment, poverty, social unrest. The world changed, but economics refused to evolve, and that resistance would soon have catastrophic consequences. The early 1900s delivered warning after warning. Banking panic swept the United States. European debts spiraled. Markets trembled at every political shift. Yet leaders stayed loyal to old rules. They tightened money when people needed credit. They cut spending when citizens needed support. It was as if the world followed a broken map, one that led straight toward disaster. When World War I erupted, the gold standard was blown apart. Nations printed money to survive. Debt soared. Inflation devoured savings. The war didn't just reshape borders, it shattered the global financial order. For the first time, governments discovered that economic policy was a weapon, a tool, and a lifeline. But after the war ended, they attempted the impossible, putting the shattered pieces back together as if nothing had changed. In the 1920s, major economies tried to restore the gold standard. Britain, France, America, all attempted to rewind history. But the world was no longer the world of 1913. Debt levels had exploded. Trade imbalances widened. Industrial power shifted. Reinstalling the old system was like forcing a broken clock to keep time. What followed was a decade of silent strain, pressure building beneath the surface. The Roaring Twenties looked like a miracle. Rising stocks, booming cities, glittering wealth. But it was a prosperity built on credit, speculation, and blind optimism. The financial system was stretched to its limit. Banks lent recklessly. Investors gambled fortunes. Ordinary people poured savings into markets they didn't understand. The world was dancing on a volcano and no one saw the smoke. On a single night in 1929, the illusion shattered. Markets plunged, banks failed, families lost everything. The gold standard offered no rescue, no flexibility, no mercy. It forced governments to cut spending during crisis, turning recession into depression. As unemployment skyrocketed and global trade collapsed, the world stood on the brink of economic extinction. The crisis demanded new ideas, but none existed yet. By the early 1930s, nations were desperate. Traditional economics had failed. Governments clung to failing policies, trapped by doctrines that made no sense in a collapsing world. People demanded answers. Leaders sought solutions everywhere, but none worked. It was during this darkest moment that a soft-spoken British economist began to challenge the very foundation of economic thought. In the silence of academic halls and in the turmoil of collapsing markets, one man studied the chaos and saw the hidden patterns. John Maynard Keynes didn't believe markets were naturally stable. He didn't believe governments should do nothing. He argued that economies were living systems, emotionally unpredictable and vulnerable. Keynes would not just challenge old ideas, he would overthrow them, and in doing so, he would engineer the debt-based global system we live in today. John Maynard Keynes was born into privilege, but he never conformed to the world around him. From his earliest years, he saw the patterns others ignored. While his peers memorized old economic doctrines, Keynes questioned everything. He believed economics wasn't a rigid science, it was a living story of human behavior, and that belief would one day reshape the world. Keynes surrounded himself with intellectual rebels, artists, poets, philosophers, the Bloomsbury Group. These were not bankers, nor politicians, but free thinkers who challenged society's deepest beliefs. Through them, Keynes learned to see beyond numbers. He absorbed ideas about psychology, human emotion, and the irrational nature of choice, ideas that would later become the foundation of modern economics. When World War I ended, Keynes warned the world that crushing Germany with impossible reparations would lead to economic disaster. His book, The Economic Consequences of the Peace, predicted not just inflation and unemployment but the rise of political extremism. He was dismissed as alarmist, but history proved him right. His foresight shook the foundations of traditional economics. Classical economists insisted markets always self-corrected. They believed in perfect rationality, perfect equilibrium, perfect order. Keynes looked at the chaos of the 1920s and 1930s and saw the truth. Markets were irrational, emotional, and often destructive. He attacked the old theories with precision. He accused classical economists of worshipping a fantasy that existed only on paper. Keynes believed the economy was driven by fear, hope, and herd behavior, not by formulas, not by perfect logic. This idea was revolutionary. He argued that people don't spend based on mathematical models, they spend based on confidence. And when confidence collapses, economies collapse. This insight would become the heart of Keynesian theory. Keynes was not just proposing new ideas, he was declaring war on the guardians of the old economic order. Universities rejected him, politicians feared him, bankers despised him, yet every crisis validated his theories. The more the world collapsed under outdated economics, the more Keynes' voice cut through the noise. He became the enemy of tradition and the champion of the future. When the Great Depression struck, millions lost jobs, banks failed, and global trade collapsed. Classical economists responded with silence. Their theories offered no explanation, no solution. Keynes dove into the crisis like a detective at a crime scene. He studied the data, the psychology, the human suffering, and from the ashes of the Depression, he began building an entirely new economic framework. In 1936, Keynes released the general theory of employment, interest, and money. It fundamentally destroyed the old world of economics. In this masterpiece, he argued that governments must intervene during downturns, that public spending could revive demand, that deficits long considered dangerous could save nations in crisis. Keynesian economics was born, and the world would never be the same. Keynes' ideas spread rapidly. From Washington to London, policymakers realized they finally had a blueprint to fight economic collapse. Governments began experimenting with stimulus spending, public works, and monetary expansion for the first time. Economists focused on employment rather than balanced budgets. Keynes had given the world a new weapon against recession. As the world marched toward the Second World War, Keynes' influence was growing. Nations were preparing for a rebuilt global financial structure, one that would require bold ideas, international cooperation, and a man capable of redesigning the economic foundations of civilization. That man would be Keynes. His next mission: engineer the global debt-based system that still governs our world today. As World War II neared its end, the global economy lay in ruins. Nations were bankrupt, currencies were unstable, and the financial order that had existed before the war was beyond repair. It was in this collapsing landscape that John Maynard Keynes stepped forward, determined to design a financial architecture that would prevent depressions, curb instability, and give nations the tools to rebuild without drowning in debt. But what emerged from the ashes of wartime devastation would become something far more powerful, a system that tied the world to the US dollar. Keynes proposed a radical solution to rebuild the world, a global central bank that would manage international currency flows and prevent debt crises. His vision centered on a new supranational currency called the bankor, designed not to benefit any one nation but to stabilize all economies equally. In Keynes' eyes, this would be the first global safeguard against the boom and bust cycles that had brought the world to war. The United States, untouched by the destruction that ravaged Europe and Asia, saw things differently. Its factories were booming, its gold reserves unmatched, and its political influence unrivaled. American negotiators at Bretton Woods had no intention of allowing a global institution to dilute U.S. financial dominance. Keynes wanted shared authority. The U.S. wanted the dollar to rule the world. In July 1944, 44 nations gathered in Bretton Woods, New Hampshire, to rewrite the global financial system. Keynes was the intellectual titan of the conference. Across from him sat Harry Dexter White, representing the United States, a man determined to ensure America would set the rules. The ideological clash was immediate, profound, and historic. Keynes argued for an impartial global currency to prevent imbalances and avoid long-term debt accumulation. The United States countered with a starkly different plan, a dollar-anchored system where all currencies would peg to the US dollar, and the dollar itself would be tied to gold. Keynes saw the danger. A world dependent on a single nation's currency was a world vulnerable to unequal power and future crises. With two-thirds of the world's gold reserves housed in American vaults, the U.S. argument dominated. The world accepted the dollar as the center of global finance. Every nation agreed to peg its currency to the dollar. In return, the U.S. promised that dollars could be exchanged for gold at a fixed price. It was the beginning of an era where the dollar became not just a currency but the backbone of international debt, trade, and power. Keynes warned that a dollar-centric system would inevitably push poorer nations into debt while rewarding surplus countries like the United States. Deficit nations, he argued, would be punished and forced into austerity, the exact opposite of his philosophy. His warnings went unheeded. He predicted that without mechanisms forcing both deficit and surplus countries to adjust, the system would one day collapse under its own imbalances. From these debates emerged the International Monetary Fund, a powerful institution designed to monitor exchange rates and provide emergency loans. But Keynes' idea of a global central bank was watered down. The IMF became more enforcement agency than stabilizing force, often imposing strict conditions on borrowers. The mechanism intended to stop future crises would ultimately contribute to cycles of national debt dependency. Alongside the IMF, the World Bank was created to help nations rebuild, but its financing model relied heavily on loans, which meant countries seeking infrastructure and economic expansion were encouraged to borrow. In practice, development was tied to long-term debt. The institutions designed to restore global prosperity became engines of global lending, embedding debt into the reconstruction of the modern world. By the end of the Bretton Woods agreements, a new financial world had been born, one built on dollars, global institutions, and the widespread use of debt as a tool of development. Keynes' dream of a balanced, cooperative global system had been reshaped into a structure where borrowing became the lifeblood of economic growth. This new system would fuel decades of expansion, but at a cost the world is still struggling to understand today. By the dawn of the post-war era, the United States emerged not merely as a victor of conflict, but as the architect of a new global economic order. Its factories were running at full speed, its industries unmatched, and its currency now the anchor of world trade. The dollar was no longer just America's currency, it was becoming the world's currency, and with it came the rise of a debt system that placed the United States at the very center of global finance. In the years after the war, countries needed to rebuild railways, factories, cities, and entire economic systems. But reconstruction required one essential resource: US dollars. Dollars were needed for imports, for loans, for reconstruction materials, and for global trade. The Marshall Plan, while generous, also had another effect. It tied Western Europe's economic survival directly to the American monetary system. At Bretton Woods, the United States pledged that any foreign government could exchange dollars for gold at $35 an ounce. This promise created the illusion of stability, a guarantee that the dollar was as good as gold. But beneath the surface, a problem was already forming. The US printed more dollars than its gold reserves could support. The world trusted America, but it did not realize that this trust would one day create the greatest monetary tension of the 20th century. Keynes had warned that when one nation's currency dominates global finance, imbalances inevitably follow. And by the early 1950s, his concerns were becoming reality. The US ran trade surpluses while Europe ran deficits. Nations were importing more than they exported and borrowing dollars to cover the gap. Debt began to accumulate not as a tool for growth, but as a necessity for survival. As development accelerated in the post-war world, nations discovered an unavoidable truth: if they wanted growth, they had to borrow. The World Bank encouraged infrastructure loans. The IMF promoted stabilization loans. Western banks offered commercial loans. The result was a new global paradigm: development through debt. Growth, modernization, and global integration all became tied to borrowing from dollar-based institutions. The Cold War transformed global finance into a strategic battleground. The United States used loans, aid packages, and dollar-based alliances to influence countries in Asia, Africa, Latin America, and Europe. Debt became a diplomatic instrument, a way to draw nations into the American sphere without firing a shot. The financial system designed at Bretton Woods became a powerful tool for geopolitical influence. By the 1960s, something unexpected happened. Europe and Japan had rebuilt, their industries were thriving, and their currencies were stabilizing. For the first time since Bretton Woods, the United States was no longer the only economic powerhouse. Dollars were flowing out of America and into global markets far faster than gold could back them. The world held too many dollars and too little faith in the US gold promise. The more the world held dollars, the more fragile the system became. Economists called this the dollar glut. If nations demanded gold in exchange for their dollars, the US gold vaults would be emptied. This was the Achilles heel of Bretton Woods, an imbalance Keynes tried to prevent but could not stop. In the late 1960s, European nations, especially France under President Charles de Gaulle, began openly questioning America's monetary power. De Gaulle accused the US of enjoying an exorbitant privilege, printing dollars that other nations were forced to accept. France demanded gold for its dollars, and others began considering the same. The world had awakened to the imbalance Keynes feared. By the end of the 1960s, the global monetary system was in crisis. Dollar reserves had expanded beyond American control. Gold coverage was insufficient. European nations were rebelling. Inflation was rising, and the US faced an impossible choice: defend gold supplies or maintain its global dollar dominance. The debt-driven financial order that began at Bretton Woods was entering its most dangerous phase, and within a few years everything would collapse. By the early 1970s, the global financial system was in a state of quiet panic. Nations no longer believed the United States could maintain its promise of exchanging dollars for gold. As Europe and Japan grew stronger, their confidence in the dollar weakened. Gold reserves were falling, dollar holdings were rising, and the imbalance Keynes had warned about decades earlier was turning into an unavoidable crisis. On August 15, 1971, President Richard Nixon appeared on national television to deliver a message that would change the world economy forever. With calm authority, he declared the US would no longer allow dollars to be exchanged for gold. This was the end of Bretton Woods. The dollar was no longer backed by anything. The global financial order, once built on gold, now floated freely on trust. The world was stunned. For decades, the gold peg had been the foundation of global stability. Without it, currencies began to fluctuate wildly. Exchange rates became unstable. Inflation spread rapidly. Governments scrambled for solutions. A financial earthquake had been set in motion, and the aftershocks would reshape the architecture of global debt for generations. With gold gone, the world entered a radical new era. If money could no longer be tied to a physical asset, then its value would come from government decree, and that decree relied on borrowing. Debt became the backbone of global economics. Nations issued bonds. Banks expanded credit. Consumers borrowed more. The modern debt-based system had officially been born. Keynes had predicted that a system dominated by a single currency would lead to instability, imbalances, and ultimately collapse. His fears materialized with stunning accuracy. The end of Bretton Woods created the very world he had tried to prevent, a world in which debt grew endlessly, unrestrained by gold or by the balanced trade rules he had envisioned. With gold gone, the US needed a new anchor for global dollar demand. That anchor became oil. In a series of strategic agreements with Saudi Arabia, the US ensured that global oil would be priced exclusively in dollars. This single move guaranteed worldwide demand for the American currency and cemented the dollar's dominance. In the new floating rate world, once currencies were no longer tied to fixed values, they floated freely in global markets. Exchange rates now shifted daily, driven by speculation, interest rates, capital flows, and geopolitical events. This new system gave nations flexibility but also exposed them to volatility. Financial markets expanded dramatically, and with that expansion came new opportunities, new risks, and new waves of global borrowing. Freed from the constraints of gold, governments could now issue as much currency and credit as they needed. Central banks expanded their balance sheets. Nations borrowed more. Corporations borrowed more. Individuals borrowed more. Global debt accelerated at a pace the world had never seen. What began as a temporary solution became the new normal, economic growth powered not by savings, but by borrowing. The post-1971 era saw the rapid rise of investment banks, hedge funds, and financial institutions that thrived on debt issuance and speculation. Finance began to overshadow traditional industries. Money itself became the most powerful product. The global elite shifted from manufacturing to financial engineering, leveraging debt as the engine of wealth creation. The collapse of Bretton Woods marked the transition from a gold-backed world to a debt-backed world. Keynes' dream of a balanced system dissolved, replaced by a structure that rewarded borrowing, speculation, and deficit spending. The dollar remained supreme, but its supremacy was now supported by debt, strategic alliances, and global financial markets. The modern world economy, with all its strengths and vulnerabilities, was born from this seismic transformation. John Maynard Keynes sought a global financial system that would prevent depressions, protect nations from economic shocks, and stabilize trade. In many ways, his vision succeeded. Governments today manage economies actively. International institutions exist to monitor financial stability, and central banks influence markets globally. But his dream of balance and fairness was reshaped. What emerged was a world dominated by debt, anchored to the dollar, and governed as much by power as by principle. The US dollar remains the linchpin of international finance. Almost every global transaction, commodity trade, and foreign reserve depends on it. Nations borrow dollars to fuel growth. Companies raise dollars to invest globally. The supremacy of the dollar has created stability but also dependency. A single nation's currency dictates the economic fate of the entire planet. Debt drives the modern economy. Governments issue bonds to fund infrastructure and social programs. Corporations borrow to expand, innovate, and acquire competitors. Individuals use credit to buy homes, cars, and education. Keynes' ideas enabled governments to intervene and stimulate demand, but the result is a world in which borrowing is constant and debt is nil. From the 1980s debt crises in Latin America to the 2008 global financial meltdown, Keynes' warnings about imbalance and instability have proven prophetic. When nations or markets borrow too much, confidence collapses. When speculative bubbles form, economies crash. Keynes understood these vulnerabilities, and the modern financial world continues to navigate them, often imperfectly. Central banks now manage interest rates, inflation, and liquidity, a direct realization of Keynesian principles. They act as lenders of last resort, controlling the supply of money to avoid total collapse. Yet this power also perpetuates dependency on debt. Central banks control the very mechanism that fuels the global economic system Keynes envisioned. But the outcome is a tightly interlinked web of obligations and financial leverage. Countries today are deeply indebted. Sovereign debt allows governments to fund projects, social programs, and defense, but it also limits independence. Key economic decisions are influenced by creditors, global markets, and rating agencies. Debt is no longer just a tool, it is a structural feature of the modern global order. a direct consequence of the system Keynes helped design. Trade, investment, and credit connect nations more tightly than ever. Economic shocks in one country ripple across the globe. While Keynes envisioned cooperation to prevent crises, the modern world's interdependence means that local mistakes, policy errors, debt mismanagement, speculative bubbles can become global catastrophes. The financial web he helped create is both a source of strength and vulnerability. Derivatives, credit default swaps, securitized debt, and global bond markets create layers of complexity unimaginable in Keynes' time. These innovations can boost efficiency and liquidity, but they also amplify risk. The system he helped design relies on trust, confidence, and continuous borrowing, and when those elements fail, chaos can spread rapidly. Despite the evolution of the financial system, Keynes' ideas remain central. Stimulus spending, counter-cyclical policy, and government intervention in recessions are now standard practice. Every major economic crisis invokes a debate over Keynesian solutions. His intellectual legacy endures, a reminder that economies are human systems, driven by psychology, confidence, and decision-making, not just numbers. Today, the global economy is a vast interconnected system built on borrowing, guided by central banks, and anchored by the US dollar. Debt is no longer optional. It is the lifeblood of growth. Keynes' revolutionary ideas on government intervention, international cooperation, and economic management have shaped this world. But the system he envisioned, altered by human ambition and power, also created vulnerabilities that continue to define global finance. The legacy of Keynes is everywhere, in our money, our policies, and the very structure of the world we live in.